Good afternoon from sunny Vienna and welcome to another BMCP Live. My name is Alexander, co-founder and managing partner of Manta Capital Partners, and I'm your host today. Since the beginning of this year, cryptocurrencies, in particular Bitcoin, have once again attracted lots of media attention, especially due to the decision of certain large corporates such as Tesla to invest parts of their cash reserves into crypto. But crypto assets in all its various forms are also becoming popular as a financial instrument among retail investors. Today, we're talking about crypto taxation. And you might ask yourself, why is crypto taxed at all? Or how do I tax my crypto? In order to answer these questions and many more, I'm very happy to welcome Mr. Michael Petritz, partner and crypto tax expert at KPMG Austria, as well as Michael Deichsel, senior associate with KPMG Austria, and Florian Wimmer, co-founder and CEO of Blockpit, one of the European crypto tax startups. Together, they also recently published a crypto tax guide for Austria and are for sure one of the experts in the field of crypto taxation in Central Europe. I kindly ask Florian and Michael to shortly introduce yourselves.
Thank you, Alex. Thanks for this kind words and this nice introduction. Florian, I'm Frank and I'd like to go first if that's okay for you. Yeah. Michael Petritz, KPMG tax partner. I specialize in taxation of international individuals. Can be entrepreneurs, can be high net worth individuals. And for those individuals, the asset class, the new asset class of cryptocurrencies is becoming more and more attractive, and so are the tax problems. We will focus then in our short speech on typical problems which can be faced when investing in cryptos. The area, and I want to comment on that first in the beginning already, is that a lot of the issues which are currently discussed are not solved or not addressed by tax authorities directly yet. So this is a challenging and thrilling field of expertise, but more developments to come, and this is what makes it so interesting for us to be here in the first row. If that's okay, I would turn over to Michael Deichsel.
Thank you, Michael. My name is Michael Deichsel. I'm also with KPMG Austria. I'm happy to be here as Michael's assistant today. We are both have specialized in the taxation of crypto assets, and besides my work with KPMG, I'm a teaching and research assistant at the Vienna University of Economics and Business, where I primarily focus on the accounting and tax treatment of crypto assets, both for national and international purpose. It's your turn, Florian. Thank you.
Thanks. Hello, everyone. Thanks for having me. I'm Florian Wimmer. Personally, I invested in cryptos in 2015, so I experienced all the hassles when it comes to taxation myself. Tried out everything technically possible on the blockchain, you could say, which led me to co-found Blockpit in 2017. We're a software development, basically a company focused on automated reporting and transaction analysis in terms of compliance. With the main product, which is called CryptoTax. So we're basically offering software for residents in various countries in the EU and US for automated crypto tax reporting based on a tax framework also developed together with KPMG. And yeah, I'm gonna give you a little intro into that later on as well.
Thank you very much. Before starting with the presentations, please note the following. For any questions you may have today during this presentation or afterwards, please use the Q&A function at the bottom of your Zoom window. We will try to answer all your questions within this session. Also, this session will be recorded, or is already recorded, and will be published on our YouTube channel. So if you need to leave early or you want to review it, register for our newsletter and you will get the link to the recording within the next days. Yes, I think that's all from my side at the moment. And now I'm pleased to ask Michael to start with the first presentation.
Michael, can you please share our slides?
Of course. The slide should be available by now.
Can you switch into presentation mode also?
Yeah, of course. Sorry. Oh, okay, now it's working. So do you want to do some introductory words, Michael?
I will start and then we will do the presentation together, Michael. Thanks for that. And thanks for putting together our presentation. Speaking in front of such an international audience is not easy, being a qualified tax advisor only in my home tax law, which is the Austrian tax law. However, I guess what we have seen in recent months or years, that the problems arising in different jurisdictions are quite similar. What we have also seen and learned is that let's put it that way, the Wild West times in not taxing my cryptos has gone due to international developments which are either pending or have already been implemented. Michael will explain about that in a minute. Yeah, but what we have seen in the past years, that there was a tendency of maybe also due to lack of knowledge how to tax cryptocurrencies, and meaning that the gains on cryptos were not taxed. Yeah? This is definitely not a problem in years where losses are incurred. Since then, there is no tax at all in wide fields. Yeah, but in years when developments in the asset values are changing or maybe are also rising, then there have been gains, and then we have to ask ourselves if there is any taxable gain to be taxed. To start our short talk, I want to put out that the tax law applicable is usually the tax law in which the investor is resident. Nevertheless, it's not as important where the asset actually accrues from, or in which wallet where the wallet is actually located, or where the company providing the wallet is located. Yeah? So as a ground rule, it's always important to follow the tax rules of the country where you're resident. There are for sure also different categories of taxpayers to be analyzed, whether you invest as a company or as an individual, or maybe as a trust or private foundation. So different rules may apply here. Yeah? However, we have interesting international developments which tend or have increased the tendencies that tax authorities are also looking for any unpaid gains or taxes on gains in cryptos. And Michael, I turn over to you that you should explain it a little bit about the recent development in the fifth anti-money laundering directive, as well as in the international exchange of information, which has various types, but is going to also imply or have an impact on crypto assets as well.
Of course. Thank you very much, Michael, for the first words. As Michael already pointed out, tax authorities and as a result, taxpayers as well are facing challenges concerning the taxation of crypto assets. And this is basically due to two major things. On the first hand, we have a new unparalleled technology. And on the second hand, we have what Michael already mentioned, we have constantly changing legal environments that pose a challenge to the taxpayer. If we look at the technological aspect, why is it so hard for jurisdictions to come up with proper guidance concerning taxation? This is basically due to the technology of crypto assets itself. We are currently faced with an unparalleled hybrid phenomenon, which comprises the characteristic of both intangible assets, capital assets as a means of payments in a variety basically the major thing is that the economic good as well as the value are virtually created from the underlying algorithms, and the value development is simply determined by trust that users place into the respective network. As a result, it is problem for tax authorities, not only in Austria and Europe, but worldwide, are struggling to provide proper guidance. What we have seen in the past years is, for example, the US did it in 2014, and in Austria, for example, we have since 2017, we have rudimental guidance concerning the taxation of transactions with crypto assets that is partially inconsistent with current tax provisions, and that only cover a few of these numerous possible transactions. For example, in Austria, the current guidance only covers mining or lending. So there's still so much work to do. There are so many transactions uncovered, because we always have to keep in mind that there is an incredibly large number of different ways of how crypto assets can be structured. So there is an equally large number of possible transactions that all require a case-by-case assessment, a tax assessment. Moreover, the characteristics of crypto assets, hybrid tokens, for example, can change over time. And this makes it really hard for tax authorities to come up with reliable and proper guidance. And consequently, this also leads to difficulties for the taxpayers and to uncertainties, because usually what we can see when we have an investment, when we have shares, for example, is that we have a withholding tax, a capital gains tax at the source, which is not the case in most cases for crypto assets, since they do not qualify as a financial instrument, and therefore the taxation has to be carried out in the means of a tax assessment. So a taxpayer must determine the income type and the applicable tax rates on their own, and that's what makes it for the taxpayer really hard. And what we have seen in the past is that the majority of the taxpayers is often unaware of the correct tax treatment. So that's where really work has to be done by the tax authorities. The second difficulty we are facing is this constantly or rapidly changing legal environment. Crypto assets are criticized by the European Union or by other governments in two terms. The first is the lack of regulatory instances with crypto assets. And the second one is the possibility of money laundering and tax evasion through the use of crypto assets. We have seen developments in recent years, especially in the recent 2 years, besides the European Union. For example, the 5th EU Anti-Money Laundering Directive, which is compulsory enforced for each member state since January 31st of last year. Which, for example, mandates crypto exchanges to comprehensive due diligence obligations. So, for example, crypto exchanges have to determine the beneficial owner, the person which is behind this investment. They have to determine where the money comes from. So we're facing an increasingly tight regulatory framework. For the first time with the 5th Anti-Money Laundering Directive, the term virtual currency has occurred. Virtual currency is the first attempt to have a uniform definition for a cryptocurrency, which is defined by the European Union as a digital representation of value that is not issued or guaranteed by a central bank or a public authority, is not necessarily attached to a legally established currency, and does not possess a legal status of currency. That's really important, but is accepted by natural or legal person as a means of taxation. And if we look at this, we can clearly see one thing, that there is no technology mentioned. there is no specific type of cryptocurrency mentioned. So this was intentionally kept very broad, this definition, to encompass every possible kind of cryptocurrency. However, authorities and the Council of the European Union as well have felt that this first step was not enough. For example, if we take our bank accounts, by now for years, the member states of the European Union at the beginning and at the end of each fiscal years automatically report the balances of investments to each other. That's the so-called DAC, Directive on Administrative Cooperation. That still does not encompass the automatic information exchange regarding crypto assets. So there is a proposal by the European Union to amend this directive to also include transactions with crypto assets and e-money. That's the first part of this proposal, and the second part of the proposal is that to implement another definition, a union-wide common definition of the term crypto asset. A crypto asset suggested to be a digital asset based on the DLT and a cryptography. What we can see here now, if we compare this to the definition of virtual currency, that it is surprisingly narrow. It now definitely states a certain type of technology, and it has to be seen how things develop, but it's a distinction between the most common asset classes should also be here taken into account. But of course, this is only a proposal. We have to wait and see how things are going.
Sorry, Michael, to come in here. Sometimes these developments can also happen fast, as we have seen after the last financial crisis, where foreign accounts were not reported, but since then the world has changed in a transparent way, meaning that the bank information held by a foreign account are nowadays shared by over 160 countries worldwide. There's the FATCA agreement, there is the common reporting standard. So things can change quite fast, and we see a similar development coming here also in the field of cryptocurrencies. Not yet implemented, but can happen quite fast.
Thank you, Michael. We have now taken a short look on the difficulties, the new technology on the one hand, and the rapidly changing legal environment on the other hand. And now we would like to point out an overview how these difficulties actually challenge, in what ways these difficulties are challenge the taxpayer. The problem is, as already mentioned, the view of most jurisdictions, tax authorities, and as well as the prevailing opinion in the literature, crypto assets in most cases, and it's very important to say that in all, but in most cases, do not represent a financial instrument, and they are not a currency neither. So it is an asset that is comparable to financial asset, but it is not a financial asset. It is a non-physical, it is an intangible asset that does not possess the state of a legal currency, because there is no compulsory acceptance and there is no issue by a central authority, for example, a European Central Bank, etc. It is also, in most cases, no capital asset, and for tax purpose, as transactions with capital assets usually involve the transfer of capital, realized increases of such capital values, or derivatives, which pose a prerequisite for such classifications. Of course, there can be transactions, there can be assets that do fulfill this criteria, but if we take the ordinary transactions with Bitcoins, with a utility token, for example, this does not pose a financial asset. However, it is very important at this point to state that there is no case law, neither in Austria nor the European Union, or anywhere in the world. We have one German case law that only states that a crypto asset, a Bitcoin, for example, does qualify as an asset for tax purpose, but there is nothing more than that on case law.
Michael, thanks for that. Maybe I can come in here also with one more comment. Yeah, and that is that we see in a lot of jurisdictions we do not have specific legislation as well. Yeah, so it's one thing not to have a specific case law, but we do not have specific rules tend to the taxation of cryptocurrencies as well. This is what we see is changing. What we also see is that tax authorities make up their mind. As you have already mentioned, there is a draft on certain tax issues from Germany. There is also some explanatory notes in the UK. So the field is developing, yeah, but it's still the opinion of the tax authorities not yet tested before courts, which is very important to know, meaning that you can also take different stands and positions when it comes to the taxation. Yeah.
Exactly. Thank you, Michael. So the main case of application, therefore, is it depends on the jurisdiction. It is often called speculative income. It is often called a private sale. We have seen in many jurisdictions that holding periods are material to determine if the income from crypto transactions with crypto assets is taxable or not. So the holding period basically constitutes the period between the acquisition and the sale of the asset. We have seen this in many jurisdictions in the EU, not only in the German or Austrian area, but also in Slovenia and France as well. For example, in Austria, we have a 1-year holding period. In Germany, it depends. You have either a 1 year or 10 years holding period. That depends if you're using this mainly as an income source or not. And what primarily concerns us here is that the loss of setting rules are often very limited concerning this income type, as for example, concerning investments in shares, which do qualify as capital assets, we have far more generous loss of setting rules than in this case. As already mentioned, there are certain transaction types or certain crypto assets that do qualify for capital assets, and the taxation regime and the loss of setting regime that goes with it. For example, transactions that have the economic characteristics of derivatives, for example, a margin trading as when they are based on underlying, or in some jurisdiction also lending is considered as income from capital, or for example, a security token is in most jurisdictions considered a capital asset. It can be in most cases a participation right, or even a shareholding, which is then also subject to the regulations, financial market authority, etc. So there are some kind of transactions and assets that do qualify as capital assets and the applicable tax regime. So then this could be the case where even on income from transaction with crypto assets, a capital gains tax or a similar taxation at the source could apply. However, we have to state that a taxation at source with regards to crypto assets is extremely rare, because in many jurisdictions you have to qualify as a bank, as a custodian bank, etc. And most cases of crypto exchanges do not qualify as such. Now we come to the last slide of the presentation, because we have now said what's difficult, what's the reason why taxpayers face these challenges, and of course, and there's the question: what can we do? What the taxpayer do? And a tax advisor or a tax advisory firm do in order to cope with this problem? And we have different approaches. In the past years, some well-founded sources in the literature have occurred that do establish some really interesting topics that, for example, that cover master nodes that cover hard fork, that cover the tax treatment of such transactions. However, we also have to keep in mind, like the guidance of the financial, of the tax authorities, that the sources in literature only represent opinions. So we often face here the challenge that the same transactions can come to completely contrary results. And what we also often do is to look, okay, is there a transaction with shares, for example, with another commodity, for example, that has basically the same or similar economic characteristics, where there is already a tax treatment that's in the best case even tested in front of a court, for example. And in any case, what we would recommend, or what we think is essential concerning crypto assets, even with regards to the holding period, is a precise documentation of all the transactions in terms of facts and in time, so that we can assess afterwards on which transaction is taxable in what way. And this was from the first part from our side. Thank you very much.
Thank you very much, Michael and Michael. We got a lot of questions. Thanks to all participants to ask. We will try, before starting with the second presentation, let's try to answer a few of the questions we received. There was one, Michael, which came directly to you, Michael Deichsel. Are utility tokens and security tokens, do they qualify as virtual currency in the definition of AMLD5?
That's a really good question, because usually the 5th Anti-Money Laundering Directive, the definition that was set out here, rather focuses on the means of payment. It focuses on the means of currency. I think you cannot determine in general if it is encompassed by this definition or not. However, as we have already established, is that we are facing a very broad definition. So in order to determine this finally, you would have to look at the exact characteristics of this asset. But to keep it short and simple, in general, I would say in some cases it could qualify as virtual currency, and in some cases not. That depends on the exact structure and would have to be examined by a case-by-case examination.
Thank you. Another question received, or actually two, was about countries where crypto is not taxed. As an example, Portugal was mentioned here, and you mentioned it in your presentation shortly. So I would have a question. So we have this harmonization efforts on a European level, in particular when it comes to definitions. But when we look into these countries where crypto is still not taxed, and actually I know two people who moved to Portugal and moved their businesses there, and they're both in crypto. Do you see any harmonization efforts when it also comes to European tax rates or procedures for cryptos?
I think, Michael, you wanted to say something, please. Oh, maybe not. Then.
Yeah, and uniformization or harmonization in tax law is extremely difficult in the area of taxation. Yeah? Why is that? Because we do not have a basis from consolidation or harmonization except guidelines and directives. Yeah? Directives in tax law have to be formed uniformly, yeah? Meaning that you have to have no country which is dissenting. Yeah? So what I do not see in the recent years to come, because we have not managed to do it in corporate income taxation as well, yeah, is that we have one set of rules for all European countries. Yeah? So this is the reality, and this will not change. Yeah? What we do see, however, is that sometimes changes in tax laws happens quite fast. Yeah? You're probably aware of this minimum tax rule, which is currently decided by the OECD and by the G7, putting into place, into effect a minimum tax rate of 15%. Yeah? So sometimes it can be done with other means as well. Yeah, I don't see these developments yet in crypto taxation. Differences in countries will always be there. For example, poker income is yet not taxed in Austria, which would bring a lot of poker players to Austria, but there's certainly loopholes available in other countries, as you have mentioned, Portugal for cryptos, for example. Yeah. Anyway, yeah, it's important to know that your tax status is dependent on your residency, and your residency depends on the factual facts of your personal life. Yeah, meaning where you do have a domicile, or maybe where you even have rooms which are available to you. Yeah, this is a test which has to be strictly performed. Which always faces difficulties in international tax law. There are important and quite famous tax cases in this issue. For example, there's a famous Boris Becker case decided by the German tax authorities, tax courts, where Boris Becker claimed to be a citizen or resident, tax resident only of Monaco, yeah, but indeed had still rooms in his parents' home available, and therefore was taxable in Germany. Yeah? So if you really consider relocating for tax purposes, please make sure that you cut your ties in the means necessary with your home country which you're living from, because otherwise there can be a tax trap coming into light later in years to follow.
Thank you, Michael. Last question before moving on to Florian, and where he will demonstrate how you can generate your tax reports for cryptos automatically. There were two questions, and I would like to combine them. One was about taxation of staking rewards. And in connection with that, one question, does holding crypto for over a year still count if it's being used as margin on a leveraged trading platform? So, yeah, probably with the staking rewards, which is, yeah. Is there any experience yet how to treat them?
Of course, that depends, as Michael already said, on the residency, on the tax law of the jurisdiction. What we have seen in Austria and in Germany, for example, as Michael already mentioned, the German tax authorities have published the draft of a rather comprehensive paper concerning numerous transactions, the tax treatment of these transactions that also encompass staking, and also what we've seen in Austria is that such staking rewards, such income is taxable. So it can be compared to a non-extensive mining from tax treatment, but it is definitely taxable, yes.
I think the question was rather like directed into the underlying asset, not the income from such activities, right? If it has any effect on the holding period of the underlying asset when you use those assets for staking, lending, margin, collateral, and stuff like this, right? That's what I understood it.
Okay.
I guess.
Yeah, of course, it does have an effect, because if the lending is carried out, then it performs a different activity. I would put it like that. And if then, for example, if you get the reward, the staking reward, if you get those coins, then the 1 year holding period in Austria, for example, would start again.
Okay, thank you very much. I hope this question was answered.
Alex, if I may, please, yeah. Staking is actually one of the hot topics right now in the area of cryptocurrencies and the utilization of it. Yeah, there are different opinions on the table. Yeah, there is no definite answer yet. Yeah, there are different positions to be taken But this question pops up in our practice like at least once or twice a week. Yeah. Or we have is a position by the German tax authorities and some legal writing here where you can get your position from. Yeah. A future will tell us who is right in his position and who is not. Yeah. But at least both positions are quite comforted with a lot of arguments. So both positions can be taken. Yeah.
So then I would suggest if there are more concrete questions, please reach out to Michael and Michael of KPMG directly. Okay, we will now go over to Florian of Blockpit, and I would kindly ask Florian to start your presentation.
Share his screen. Well, thank you, Alex, and also thanks, Michael and Michael, also for a great transition with the last sentence on your last slide, that right now it's all about documentation. So this is something that everybody can already do, even if there is still some gray areas in some jurisdictions about taxation. And I personally know the pain as one of the people who started quite early in crypto, and like doing the documentation afterwards for the previous years, because you have to do your taxes, can be really, really hard or even impossible because certain exchanges don't exist anymore, right? Blockchains shut down. Some data is just not available. And this is the big reason why we founded Blockpit. And we call ourselves right now a RegTech for transactional analysis, because we are doing a little bit more than taxation as well, just like how the circumstances made us do it. And I want to give you a short overview of what we're doing so you can better understand our services and how they could also benefit every single one of you if you're dealing in crypto assets. So we started out when founding the company in this sector. So we're having this main platform, which is called Crypto Tax. It's the tax calculation, tax reporting platform, where we are right now active in 6 countries with a country-specific tax reporting, where we're also working with a Big 4 partner in all of those countries to guarantee maximum legal compliance as far as is possible. Which basically is a portfolio tracking tax calculation platform. So you input your data, you get your tax report out, mainly for all the activities that are done on exchanges, on brokers, where you're just like doing your daily trading. And now as it came with the latest years where the whole topic of decentralized finance became really big, and it actually got possible to do daily trading. And now we have the topic of staking, lending, collateral borrowing, which is all done decentralized. So you don't have a centralized data source anymore. You have the data directly from the blockchain, which is of course saved in a format that's most likely not readable by tax accountants and also financial authorities, but is becoming more and more a part of this new financial world. So we also started going into the direction of decentralized data with our Know Your Transaction application, which we're also providing for risk scoring and some stuff for financial service providers. But in all, these two are the big pillars of our tax reporting solutions, where we're just like getting the data and basically automating the process as much as possible, giving you your personalized country-specific tax report in the end out of it. And before I go into any more information, I'm just probably choose the better way and give you a short live demo on how the platform could look like, which came to life out of our own necessities and is of course regularly developed further and further with all the changes coming up in the crypto world. So we always have to keep on that. But we wanted to make it as simple as possible and as automated as possible, because you as a trader or as an investor should focus on something else, and nobody can ask you to, learn the guidelines of taxation. You have Michael for that. So what do? We are basically gathering data, and we want to gather data in real time. We want to gather past data and future data. So we are providing interfaces two most well-known exchanges. So you could just like integrate an exchange where you're trading on, or even multiple exchanges. Most likely people who get into crypto sooner or later are going to register on more than one exchange because their asset is maybe not listed on the one exchange. Very common practice, which is an API key. So you register an API key once, give read-only access, and we basically get your transaction data from all the past activities, but also automatically for all the future activities as well. So this is a one-time setup, and once you have this key active, you're basically done, and all the rest is happening automatically. We can also do this for wallets. So here we're coming into the decentralized part. Right now for Bitcoin and Ethereum, Ethereum actually like the biggest playground right now for DeFi. And I also saw a question regarding NFTs, which is a big topic coming up now. So here we are really going already a little bit into the end game, like the perfect use case for blockchain. It is this immutable and very transparent ledger, right? So why not use this for auditing and tax purposes? So really by just like giving up the public wallet key of your wallet, we can actually read out everything that ever happened on that wallet. And once we know the smart contracts like Uniswap, 1inch, Compound, Aave, you name it, and we interpret this, we can actually transition all or translate all the blockchain data out of those contracts into transactions that are readable for tax purposes. So this is really like what it's coming down to, probably in the mid and long term, where you can automate all the reporting processes just based on your public key. Of course, we're working on different more integrations. So Binance Smart Chain coming soon. We're looking into different new ledgers like Terra blockchain, Polkadot. So this is gonna get expanded all the way. And last but not least, and something that we want to reduce as much as possible, is just like manual inputs. A lot of exchanges actually, they don't offer APIs. You have wallets that don't have a readable explorer yet. So there is always going to be some stuff that you might need to manually enter as well. Be it just like you're going out with a friend for a beer, you forgot a wallet, and he's just like, okay, I'm buying it for you, and you send me Bitcoin afterwards. This could be a taxable event in your jurisdiction, so you would have to input this as well to have like a complete documentation. So once you got all your assets and your depots, as we call them, so wallets and exchanges in there, they're going to get constantly upgraded, so you can just like keep on trading, keep on doing whatever you want. So also staking and stuff like this. This gives you then, of course, an overview of all the transactions that you ever did from day one, where you exchanged your first fiat currency into crypto, or you actually started mining, which is how it started out with me, how I got my first Bitcoins. And there are different types, and Michael already told a little bit about this, and we don't know where this is going to be in 5 years, but right now we're having a lot of different transactions types on those crypto assets. So there's this classical trade, deposit, withdrawal. You can pay with your crypto for goods and services. There's airdrops, hard forks, mining, lending, staking, margin trading, which can result in profits, losses, master income, bounties, gifts, donations, expenditures, dividends from security tokens, or dividends from other sources of income. So these have to be classified, and here again we're trying to do everything as automated as possible. So from an exchange API, we can actually already know what this deposit is because it came from an earning program or a bounty program or a staking. And the same for the whole DeFi stuff, where we can know based on the smart contract what actual type of transaction is this. Then we're having the so-called linking program. So in most jurisdictions, you actually have the need for depot separation. So if you're having different depots, you actually have to consider every depot for itself. But you can, of course, send Bitcoin from one to another. So buy Bitcoin at a German exchange and send those Bitcoin over to a Hong Kong broker, exchanges for Ethereum there. So you really need to have this whole linking down. So if you have a withdrawal, there needs to be a deposit for this. If there is not, it might not have been a withdrawal, it might have been a payment. So you gotta have to change this type to something that needs no counterpart, right? So because it was just like exited your portfolio. And once you set everything up, you have all those ready classified, hopefully fully automated, if you're not doing as many crazy things as I do. We're coming to reports, which of course are on a year basis, and you can calculate your reports from the year that you first started going into crypto. I just recalculated one here. You're getting a short overview, and depending on which country you set when you're creating your profile, or you can even change the country of residence afterwards, download the report and you're gonna get a country-specific report, of course, in your country's accepted language, as this is important for financial authorities. So right now here I have an Austrian one, I think, in this profile, which of course looks different for every country, but basically comes down to the same parts, where we're having an overview of all the important key tax values, like here speculative gains, capital gains, other income, and if possible also where you have to input this in your tax declaration. Then we're having the classical tax declaration filled out already. If you're doing it old school, you don't want to use the online declaration, but you really want to like send it via letter to your financial authority. We're having the finalized form here. And then there's a lot of different single transaction information. So really down to everything transaction. What was the acquisition cost, realization cost, what was the gain, how long did you hold the asset, what was the tax event that you triggered with this, broken down to every depot, to every currency. So this is just like for the authorities to counter check if this report is actually correct, if they want to do it. Hopefully they already know a lot of our reports and at some point stop controlling it of everything in transaction. So this is the actual product. Like this report is meant to give maximum legal security, give you a documentation. And always, of course, keep up to regulatory changes that might come or will come in the future by us working together with tax advisors like Michael and Michael to always be up to date here. And last but not least, the good thing about having a documentation like this and not doing it yourself or doing it manually is that you're really like in real time up to date on what's happening in your portfolio. So you know the taxable gains, you know eventual losses that might be standing. So you could actually act optimized. Let's say you have in different depots, you're having Binance depot and a Coinbase depot, and you have Bitcoin there, and you want to sell Bitcoin. You can quickly look what would be the ideal tax case, maybe realizing losses on the one depot while realizing gains on the other depot. So this really gives you like a daily use case for tax optimized or just like tax relevant trading activity as well. Right, so this was a quick overview of the program. It's free to use for everyone, up to 25 transactions per year, but you can actually like just start the documentation even if you have 1 million transactions. So we don't charge you, we only charge for the tax reporting. But if you want to be safe in the whole documentation, better start now. And just like input all your data. We're actually doing this pseudonymous, so you don't need to give us any personal data. We don't want it. We don't want to be a target for financial authorities or hackers or whatever. So we don't want all this data. Everything is encrypted. We just need an email for registration. This could be some fake email. We actually want to go away from this as well. So we're already looking into some decentralized login systems where you don't need any data at all. Right now, it's available in those 6 countries. So we're Central Europe, Austria, Germany, Switzerland, France, and Spain, and the US. We're gonna keep adding new jurisdictions, probably at least 1 per quarter. Hopefully in the future, even more. The goal is to be all over the EU in the end of 2023 and cover all those jurisdictions. With a country-specific and audited tax framework. Well, thanks for listening and giving me some screen time.
Thank you very much. Very interesting, Florian. I know you now like several years, but I've never got a ding more. So yeah, thanks for that for sure. There are a lot of questions again. So I would just read some. probably some easy ones. Can the report be in different languages? What languages do you support?
So right now we're supporting 4 languages, which is German, English, Spanish, and French. The reports, though, are in the country's respective language, except for Switzerland, where you have 3 languages. This is something that we might look into adding later, like also changing the reports language. But as of now, in most countries, the report is only accepted in a native language. So you can, of course, change the interface language and everything, but in the report right now, it's coming down to the base language of the country. But something that I'm going to put on the to-do list to implement as a feature.
And there was another question saying, what about other blockchains, such as Siliqua, Binance, Smart Chain, Mainnet? So probably a more general question, how long does it take to integrate an additional exchange or blockchain?
It totally depends. So Binance Smart Chain, for example, it's just a clone of Ethereum with different parameters. So we're going to go live with this probably next month. Sequila, we didn't even look at it yet. So there's also now the Polygon blockchain, which is interesting as it's getting a lot of more traction. It's also an Ethereum clone. So everything that's totally different, totally new is gonna take longer. But in general, and we're working on increasing our team of developers, probably around 2 to 4 weeks per new exchange. For new blockchains, a little bit longer, especially if there is a DeFi going on and we want to cover the main smart contracts on there.
Okay, and thank you. And one question regarding, I would say, pricing. So you said up to 25 transactions a year are for free. What is your pricing structure? Do you have like for individuals and also corporate pricing? And do you have several levels of pricing? How does it look like?
So right now we're having the 25 free, and then the next tier is up to 25,000, which is 199 euros for the tax year. So a one-time payment for tax year. You can generate as many reports as you want once you unlocked the tax year. We are thinking about doing some in-between tiers, which right now changing our payment provider, which makes it a little bit easier to introduce those. There is a lot of new features coming up as well, like really like real-time simulation of trades before you even do them. So you can just like simulate what would be the ideal tax case from a mathematical perspective, which will then only be available for higher tiers. So once those are out, there's definitely going to be some mid-sized tier as well for just like tax reporting for a little under 2,500 transactions maybe.
Okay, thank you very much. Yes. So we have, I'm just looking at the time. We have, I think, one question, which is in both directions, but most probably KPMG. But Florian, you also mentioned it. What about losses? So, yeah.
Offsetting losses from gains.
Gains and yeah, so one from a technical perspective, Florian, but also from a tax perspective, how are crypto losses treated, or are they treated at all?
Okay, I'm gonna start with the technical thing. So from technical perspective, of course, no problem at all. It's just mathematics. It's different, and I'm probably gonna take a little bit away from Michael. It's like depends on your jurisdiction you're in, right? And depends if you're a private or a corporate trader.
Exactly. If we look at the private investment, as Florian already mentioned, it depends on the jurisdiction. But we have shortly pointed it out in the presentation that if we are if we talk in terms of those speculative gains, those private sales, usually a loss offsetting is only within this income type. Let me give, for example, in Austria, you can set gains and losses if they are same type. If you have, for example, gains with speculative income and losses with income from capital assets because you have experienced a loss with a utility token, for example, this cannot be offset. but of course, it always depends on the jurisdiction and how they categorize the income.
Thank you very much. Michael, probably you mentioned in your presentation at the very beginning, I think a reporting standard. There was one question, which standard, what was the standard mentioned in your comment? Do you remember?
You mean the DAC, the Directive on Administrative Cooperation? I think if it's about the automated exchange of information.
Okay.
Big event coming up, really big event, because like broken down, it means that the authorities know what you have been trading on a transactional basis if it comes like the draft it is right now. So it's basically automated exchange of all data on centralized exchanges.
This has happened already, and is already reality in a lot of other fields of taxation. Yeah. The last item which was added was to get all the rental income from rental providers, internet platforms. Yeah. So this is taking place nowadays, and is including more and more asset classes.
Okay, so I would say, as we already have, it's in a few minutes, it's 5 p.m. We have many questions still open. We won't be able to answer them in this session, but I would like to thank Michael and Florian for your participation. We will share the contact information in the follow-up mail to our participants. So everyone who is interested or has questions regarding crypto taxation, please reach out to KPMG directly, or if you want to open an account with Blockpit, please go to Blockpit.io. And yeah, so from my side, thank you very much. It was a pleasure talking to you. The time was, as usual, too short. The topic is very broad, and yeah, probably we make another session and narrow it down to certain questions in the future. In the meantime, have a sunny evening wherever you are, and if you have some last words, Florian, Michael.
I tried to answer the questions like in chat. I hope I got everyone.
Very good.
Thank you very much for hosting us today.
Okay. Then everyone, have a nice evening and see you soon.
Very good one.
Have a great evening.
Have a good evening. Bye-bye.